All right, so you've sent over a ton of stuff for us to go through this week, leading into the week of March 17th, 2025. A lot of economic reports and market analyses for this deep dive.
Yeah, there's a lot there.
Yeah.
And I'm sure you're trying to figure out, what you really need to focus on, what's going to move the markets, and what you can maybe just kind of keep an eye on.
Right.
So the mission here, I think, is to really pull out those key insights from all of these reports so you can navigate the week ahead without getting completely overwhelmed.
Exactly. And really understand what to watch and why it matters. So let's jump right in. We'll start chronologically with Monday, March 17th. And the first thing that pops out is retail sales for February expected to increase somewhere between 0.5 and 0.7%.
Okay.
Now, this is after a 0.9% drop in January, and the reports are saying that was mainly due to weather.
Right.
So I guess the first question is, beyond the headline number, what are we really looking at here with retail sales?
Well, retail sales are really a critical indicator of consumer spending.
Right.
And that's really the engine of the U.S. economy.
So, that expected rebound, it suggests that January's dip was probably just a blip.
Yeah, hopefully.
And a stronger than expected number would really signal that consumer demand is resilient, and that would be, a positive sign for the economy overall. But on the flip side, it could also reignite those inflation concerns.
Right, if people are out there spending and prices are going up.
Exactly.
Yeah.
Strong spending could keep that upward pressure on prices. Now, on the other hand, if we see a weaker number, that might signal that consumers are becoming more cautious.
Okay, more hesitant to spend.
Yeah, maybe pulling back a little bit in response to those, persistent price increases that we've been seeing.
Yeah, that makes sense. Okay, so also on Monday, we've got the NY Empire State Manufacturing Index for March projected around 6.00 for Q1.
Okay.
Which is a pretty big swing from January's negative 12.6 and then February's 5.7.
Mm-hmm.
So this is a regional index, obviously, but why should we be paying attention to this on a national level? Well, what's interesting about the Empire State Index is it often acts as kind of an early indicator for the broader manufacturing sector in the U.S.
Okay.
New York has a pretty diverse industrial base, and it's a major economic hub, so its trends often reflect those national patterns.
Mm-hmm.
So that expected positive reading could signal a real pickup in manufacturing activity after kind of a sluggish start to the year.
Right.
And if it really blows past expectations, that might suggest even stronger momentum in the manufacturing sector nationwide, which would be a good sign for overall economic health.
Okay, good to know. Then we also have business inventories for January, which we already know came in at negative 0.2%, so inventory slightly decreased.
Okay.
What's the story there?
So a small decline in business inventories, it means that companies sold a bit more than they replenished in January.
Okay.
And that could point to healthy demand. Right? Businesses are successfully moving their products. But, if this trend continues and inventories get too lean, it could actually lead to problems down the road. Maybe challenges in meeting food for demand, potentially bottlenecks in the supply chain, or even, contributing to inflation if demand outstrips supply.
Right, if there's just not enough stuff to go around.
Exactly. And it's interesting to consider this, alongside those retail sales figures.
Yeah, that connection makes sense. Okay,
Yeah.
And to round out Monday, we have the NAHB Housing Market Index for March consensus at 44. This gives us a sense of how home builders are feeling, right?
Yeah, exactly. The NAHB index, it surveys home builders about their assessment of current and expected single-family home sales. And a reading below 50 indicates more builders view conditions as poor than good. So at 44, that suggests, a continued cautious outlook among builders.
Okay.
And that likely reflects the, ongoing impact of those relatively high mortgage rates. I think your reports mentioned around 6.8%.
Yeah, I see that here.
And the persistent affordability challenges that are, keeping some potential buyers out of the market.
Right, unable to buy a home.
Exactly.
Okay, so moving on to Tuesday, March 18th. We get more into housing with the preliminary building permits for February, expected at 1.471 million. And then housing starts for February, consensus at 1.34 million. So how do these two kind of fit together?
Well, think of building permits as kind of the green light for future construction, right?
Yeah.
So they indicate the number of new housing projects that have been authorized. Housing starts, then tell us, how many of those authorized projects have actually broken ground.
Okay.
The fact that these numbers are holding up, reasonably well despite those headwinds in the housing market suggests there's still some underlying demand.
Right.
And that builders are, proceeding where they can. Now, interestingly, Robert Chen over at Morgan Stanley, he's particularly focused on whether that recent dip in mortgage rates we saw at the end of last year is starting to translate into increased buyer interest, which would ultimately provide a stronger tailwind for both permits and starts.
Yeah, that makes sense. If people aren't buying, eventually no one's going to build anything.
Right, exactly.
Okay, so also on Tuesday, we have industrial production for February expected to increase 0.4% month over month and capacity utilization at 77.7%. What should we be looking for in these numbers?
So industrial production, it tracks the output of the industrial sector, manufacturing, mining, utilities, and a 0.4% rise would indicate continued expansion in this really crucial part of the economy.
Right.
Capacity utilization tells us how efficiently those industrial facilities are operating. And at 77.7%, that suggests a relatively healthy level of utilization.
Okay.
Now, if that number climbs a lot higher, it could signal potential inflationary pressures.
How so?
Well, as industries get closer to their production limits, they could start to struggle to meet increasing demand.
Okay, so they're running at full capacity.
Yeah, and that can lead to price increases.
Got it. Okay, big day. Wednesday, March 19th, the Federal Reserve's interest rate decision. And the market is pretty much expecting no change, keeping rates at 4.25 to 4.50%. But as our sources all point out, the actual decision is almost secondary to everything else that comes out of this meeting.
Right. I mean, the rate decision itself is pretty much baked in at this point.
Yeah, everyone's expecting it.
But this statement, the updated economic projections, and especially the dot plot, they're all going to be scrutinized really closely.
Okay.
That dot plot review shows where each member of the Fed's policy setting committee expects interest rates to be in the future. So Jennifer Hayes over at Capital Markets Research, she's asking the key question. Does the Fed still anticipate those 3 additional rate cuts this year?
Right, because that was kind of the talk.
Yeah, that's going to be the key piece of forward guidance that everyone's going to be analyzing.
Okay. And then, of course, we have Jerome Powell's press conference. And we're being told to pay very close attention to his tone, particularly in light of recent comments from Fed officials like Christopher Waller suggesting patience remains warranted, and Neil Kashkari emphasizing the need to ensure that inflation is truly contained. Sounds like they're walking a bit of a tightrope there.
Yeah, they are. The Fed is in a really delicate situation right now. They need to signal that they're committed to bringing inflation down.
Right.
But without spooking the markets or triggering a recession.
Right. So what are we listening for specifically?
Well, Powell's choice of words, any shifts in his rhetoric compared to previous press conferences.
Okay. Any hints about the future?
Exactly.
Yeah.
Will they cut rates further?
Yeah.
And if so, when and how quickly?
Right.
His overall assessment of the economic outlook, that's going to be key. And, any perceived change in their stance could really move the markets.
Okay, got it. Now, interestingly, Wednesday also marks the start of NVIDIA's GTC conference, where they're expected to unveil some new AI advancements, maybe even their GB300 AI chip. That feels like an event with implications beyond just the tech sector.
It could be, yeah. NVIDIA is a really dominant player in the AI space, and these big announcements about new chips, they often generate a lot of excitement and investment within tech.
Right.
But given how quickly AI is being integrated across all sorts of industries, these developments could have significant long-term effects on productivity, innovation, even economic growth overall.
Yeah, it's kind of amazing to think about how quickly that's all happening. Okay, moving on to Thursday, March 20th, we have the current account for Q4 2024, and we're looking at a likely deficit after that pretty substantial $10.95 billion deficit in Q3. So remind us what the current account actually reflects.
So the current account, it basically gives us a summary of a country's transactions with the rest of the world. So that includes trade and goods and services, income from investments, transfer payments.
Okay.
And a persistent deficit like the one we're expecting, it indicates that the U.S. is importing more than it's exporting both goods, services, and capital.
Okay.
Now, that's not necessarily a bad thing in the short term, but a large and sustained deficit can put downward pressure on the dollar.
Right.
And it can raise concerns about longer-term economic imbalances.
Okay, so something to keep an eye on for sure. Then also on Thursday, we get initial jobless claims for the week ending March 15th, expected to be in the 220,000 to 230,000 range, which is pretty much in line with recent numbers. So it looks like a fairly stable picture for the labor market right now.
Yeah, that's what the data is suggesting. Initial jobless claims, they measure the number of people filing for unemployment benefits for the first time.
Right.
And a consistent number within this range suggests that the labor market remains relatively tight. Not a lot of layoffs. This is something that the Fed is definitely watching closely as they try to figure out what to do with interest rates.
Okay.
A strong labor market could give them more leeway to keep rates higher for longer.
Yeah.
Especially if inflation remains stubborn.
Right, because they don't want to cause a recession.
Exactly.
Okay, we've also got the Philadelphia Fed Manufacturing Index for March coming out on Thursday, projected to be around 15 to 20 after February's reading of 18.1. So another regional manufacturing gauge similar to that Empire State Index we talked about.
Yeah, exactly. It offers another regional perspective on manufacturing conditions this time for the Mid-Atlantic region, and consistent positive readings in both the Empire State and Philadelphia Fed indices would really strengthen that narrative that, the manufacturing sector is recovering.
Okay, that would be good news. Then after the market closes on Thursday, we get earnings from FedEx. And our sources highlight its importance as kind of a bellwether for global shipping volumes and supply chain dynamics. Expected earnings per share are $4.15 on revenue of $22.1 billion.
So what should we be zeroing in on in their report?
Well, with FedEx, you want to pay close attention to their commentary on shipping volumes, both domestically and internationally.
Okay.
Any big shifts or trends that they're seeing can give us some clues about, the health of global trade.
Right.
Their perspective on supply chain disruptions and, the impact of those global trade tensions we've been talking about, that'll be crucial too.
Okay.
If they're seeing weaker demand or increased cost because of trade, that could be a warning sign for the broader economy. Yeah, that makes sense. All right, finally, we get to Friday, March 21st, and that brings us existing home sales data with expectations for a modest 1.8% rebound after that pretty significant 5.2% drop in January. So could this be an early sign that those lower mortgage rates are starting to have an effect?
It's possible. I mean, a slight uptick could be an early indication that buyers are starting to come back to the market.
Right.
Maybe enticed by those lower mortgage rates we saw towards the end of last year. But remember, affordability is still a major constraint in the housing market.
Yeah.
So while a 1.8% increase would be, a welcome sign, it's really going to be crucial to see if that momentum continues in the coming months to confirm, real recovery in existing home sales.
Okay, so not getting too excited just yet.
Right. We need to see more data.
Okay. We also get the preliminary S&P Global Purchasing Managers Index, or PMI, readings for March on Friday, expected to hold steady around 52.5. So that's still indicating expansion in the private sector, right?
Yeah, anything above 50 signals expansion. And a forecast of 52.55 suggests that, the moderate pace of growth we've been seeing is likely continuing into March.
Okay.
This index, it gives us a pretty timely snapshot of business conditions across both the manufacturing and services sectors.
Right, so it's a good overall indicator.
Yeah, pretty broad-based.
Okay. And lastly, for Friday, we have the leading economic indicators for February. Now, our sources point out that this index has been declining for 22 consecutive months through January.
Wow.
Which sounds a little ominous, especially given that the Atlanta Fed's GDP Now model is still projecting a respectable 2.1% growth for Q1. So how do we explain that apparent contradiction?
That's a great question. So the leading economic indicators, they're meant to give us signals about where the economy is headed.
Right.
And a long decline like this often raises concerns about a potential slowdown. But the fact that current GDP growth estimates are still relatively strong, it could suggest a couple of things. Maybe some components of the LEI are reflecting weaknesses that haven't fully shown up in those broader GDP figures yet.
Okay, so there's a lag.
Yeah, possibly. Or it could be that other factors that aren't fully captured by the LEI are currently supporting economic growth, offsetting those negative signals.
Okay, so maybe the LEI is missing something.
Yeah, it's possible. It's definitely a discrepancy worth watching closely.
Okay, good to know.
Okay,
let's zoom out a bit now and look at some of the broader themes highlighted in our sources, starting with global trade tensions. These seem to be escalating and are definitely feeding into the market uncertainty, particularly the U.S. disputes with key trading partners and the recent tariffs that have been imposed.
Yeah, these ongoing trade disputes, they're a real drag on the global economy.
How so?
Well, tariffs, they act like taxes on imported goods.
Right.
Which can lead to higher costs for businesses and consumers, and that can contribute to inflation.
Right.
But on top of that, the uncertainty around trade policies can discourage businesses from investing, and it creates volatility in the markets as investors react to new developments and potential retaliatory actions.
Yeah, because no one knows what's coming next.
Exactly.
Okay.
Yeah.
We've also got a mention of the OECD's interim economic outlook report for global GDP growth, What's the main takeaway from their assessment?
So the OECD's outlook, it provides a really valuable global perspective. It helps us understand, where the U.S. fits within the broader international economic landscape.
Right.
And identify those global risks and opportunities that could, have ripple effects here.
Okay.
Their reports typically look at things like trade investment flows, inflation on a global scale.
Okay, so good to have that big picture view. And then in terms of market forecasts, Goldman Sachs has revised its year-end target for the S&P 500 downwards to 6,200 from 6,500, citing prevailing uncertainties. So that's a pretty notable adjustment.
It is. And these kinds of revisions, they really reflect the overall sentiment and risk assessment within the investment community. So Goldman Sachs lowering their target, it suggests a more cautious outlook for the stock market.
Okay.
Probably driven by, those uncertainties we've been talking about, inflation, the Fed's next moves, and of course, those ongoing trade tensions.
Yeah, it's interesting to see how international markets are performing so differently. European stocks have actually outperformed U.S. stocks year to date, perhaps helped by the European Central Bank's recent rate cut, while Chinese equities are facing some challenges, and Japan's Nikkei has experienced a correction.
Yeah.
What factors might be driving those different trends?
Well, this really highlights how economic conditions and policy responses can vary across different regions. The ECB cutting rates, it suggests that Europe's economy might be in a different place than the U.S., perhaps facing weaker growth.
Okay.
The struggles in Chinese equities, they're tied to their own specific domestic challenges, including, issues in their property sector.
Right.
And the correction in Japan's Nikkei, even after the Bank of Japan has started to normalize its monetary policy. It shows just how sensitive markets can be to shifts in monetary policy after, such a long period of low rates.
Right.
The upcoming Bank of Japan policy decision, that's going to be another key event to watch for global market implications.
Okay, good to keep an eye on that. Then we have this continued deterioration of U.S.-China relations with potential countermeasures from China in response to U.S. tech export restrictions, possibly impacting sectors like agriculture and aircraft. Martin Chen, an international economist, he warns about increased headwinds for multinational corporations and an acceleration of supply chain diversification. This all sounds like it could have pretty big real-world consequences for businesses.
Absolutely. These geopolitical and trade tensions, they have real tangible effects on businesses that operate globally.
Right.
Potential tariffs on agricultural goods or aircraft. Those would directly impact those industries. And Martin Chen's point about supply chain diversification, that's really important.
Right.
Companies are increasingly looking to reduce their reliance on single sources, particularly China, which can lead to, higher costs and more complexity in the short term, but potentially more resilient supply chains in the long run.
Yeah, that makes sense. And of course, we can't forget about those rising geopolitical tensions in Eastern Europe and the Middle East, which our sources mention as a potential factor influencing oil markets. That feels like a pretty direct link.
Yeah, geopolitical instability, it's always a risk, especially for commodity markets like oil. Any escalation of conflict in those regions can disrupt supply chains and potentially push energy prices higher.
Right.
And of course, that could feed into broader inflation.
Yeah, nobody wants that. Okay, let's shift gears a bit and talk about corporate earnings. Now, even though we're not in the peak of earnings season, we do have reports coming this week from companies like Nike, FedEx, Micron Technology, and Lennar. Each of these can give us a slightly different view into the economy, right?
Absolutely. So Nike's performance, that'll give us insights into consumer demand for discretionary goods.
Okay.
FedEx, as we've discussed, they're a bellwether for global trade.
Right.
Micron's results will reflect trends in the memory chip market, which is, vital for the tech sector. And Lennar's earnings will give us an update on the housing market.
Okay. And we've also got reports from General Mills and Darden Restaurants. Samantha Rodriguez at Global Investments, she points to this increasing price sensitivity among consumers. So these reports might tell us how resilient consumers really are and how their spending habits are changing in response to inflation.
Yeah, exactly. Are people still willing to spend on dining out at Darden or those branded consumer goods from General Mills?
Right.
Or are they tightening their belts and going for cheaper options?
Okay, so we'll be listening for any clues about that in those earnings calls. Okay, last but not least, let's touch on the technical analysis perspective. So the S&P 500 is currently trading below its recent all-time highs, with key support levels around that 50-day moving average near 5,850 and resistance around 6,000. We're also seeing a deterioration in market breadth. So what do these technical indicators suggest?
Well, from a technical standpoint, the fact that The S&P hasn't been able to stay above those record highs.
Right.
And that market breadth is weakening, meaning fewer stocks are participating in the rally. It could be a sign that that recent upward momentum is starting to fade.
Okay.
Robert Thompson mentioning 5,800 as a crucial support level. That's important. If we break below that level, we could see, further declines. And the fact that more investors are buying downside protection, which is reflected in that rising CBOE skew index, it also suggests growing caution in the market.
Okay, so people are getting a little nervous.
Yeah, maybe a bit.
Yeah.
And then you have the outperformance of defensive sectors like utilities, consumer staples, healthcare, compared to those growth-oriented sectors. That's often a sign of a more risk-averse market environment.
Right.
And the underperformance of small-cap stocks can also point to concerns about future economic growth. Okay, it's a bit of a mixed bag there. And just a quick word on Fed liquidity conditions. Our sources note the ongoing quantitative tightening by the Fed, a modest steepening of the Treasury yield curve, and continued high levels of assets in money market funds. What's the main takeaway on market liquidity?
Well, the Fed's continuing to tighten, so they're gradually reducing the amount of reserves in the banking system.
Right.
Which can make liquidity a little bit tighter.
Okay.
That modest steepening of the Treasury yield curve, that means the difference between long-term and short-term Treasury yields is widening.
Yeah.
And that's sometimes seen as a slightly more positive sign for future growth compared to, an inverted yield curve.
Right.
And those high levels of assets in money market funds, they suggest there's still a lot of cash sitting on the sidelines, maybe waiting for more clarity or, better investment opportunities.
Okay. So plenty to think about there. All right, we've covered a lot of ground really digging into those economic indicators, the upcoming Fed decision, the impact of those global trade dynamics, all based on the information you sent over. We have the key themes for this week. They really seem to revolve around how the Fed communicates its plans, even if they do pause rates. The signals we'll get from housing and manufacturing about, how strong the economy really is,
right,
and the ongoing impact of global trade uncertainties on, both markets and businesses.
Absolutely. So for you, our listener, as you process all of this, the seemingly stable labor market but persistent inflation, moderate economic growth, but all these trade uncertainties, here's a question to consider this week. Out of all the data points coming out, which single piece of information do you think will have the biggest impact on the markets? And maybe even more importantly, why? Think about how all these different economic factors are connected and how they influence each other.
Yeah, it's all about connecting the dots and forming your own informed perspective. Thanks for joining us for this deep dive.
Yeah, we hope this has helped you get a clearer picture of what to watch in the week ahead. We're always interested in what you're thinking about, so please let us know what other topics or sources you'd like us to explore in the future.
Great, thanks.
Thanks.